Today, we're going to pull back the curtain on how to read any business's financial health. And you know what the best part is? You really only need to get a handle on two key documents to do it.
I mean, think about it. A company can look successful on the outside, right? They've got busy stores, tons of employees, maybe some flashy ads. But how do you really know if it's genuinely strong and stable, or if it's just one bad quarter away from serious trouble? To find out, you've got to look past the shiny exterior and dive into the numbers.
So, let's frame this with a simple idea. Think about getting a health checkup with your doctor. They don't just glance at you and say, "Yep, you look fine." No way. They need two very different kinds of information to get the whole story. First, your doctor wants a snapshot, your vital signs, right now, in this exact moment. But they also need the story. What have you been doing for the last year? What's your lifestyle like? Well, a business is exactly the same. We need its financial snapshot, which is called the statement of financial position, and we need its story, which we find in the statement of financial performance. Okay, so let's start with that snapshot. This is the document that tells us exactly where a company stands financially at one single point in time. It's like a photograph that freezes everything in place. Now, the statement is often called a balance sheet, and honestly, that name is a massive clue. It gives us this picture that is always perfectly balanced. It shows what a company owns, what it owes, and what's left for the owners on one specific day, like, say, the very last day of the year. And you know what? It really is this simple. Everything on a balance sheet can be sorted into one of these three buckets. You've got assets, all the valuable stuff the business owns, like its cash, its computers, its inventory. Then you've got liabilities. That's all the stuff it owes to other people, like bank loans. And equity, well, that's what's left over for the owners once all those debts are paid off. And this right here is the magic formula that holds it all together. This is the accounting equation, and it has to balance, always. And you might ask why. Well, think about it. Every single thing a company owns, every asset, had to be paid for somehow. It was either bought with borrowed money, which is a liability, or it was funded by the owner's own money, which is their equity. The two sides of the equation are just two different ways of looking at the very same pile of stuff. So if the balance sheet is just a single snapshot, where do we find the story of how the business is actually doing over time? That, my friends, is where our second document comes in. This one isn't the photograph, it's the movie. This is the statement of financial performance, but you'll almost always hear it called the income statement. And unlike the balance sheet's single moment in time, this document tells a story over a period of time, like a full quarter or an entire year. It's all about measuring the flow of money coming in and the money going out to see if the company actually made a profit. And the math here is just beautifully simple. You take all the income the business brought in from its sales. Then you subtract all the costs of running the business to make those sales happen. Things like salaries, rent, marketing, you name it. And what's left over? That's your profit. Or if the number's negative, it's a loss. That's the famous bottom line that tells you if the story for that year had a happy ending. And this is basically the engine room of the business in action. A company uses its cash to buy or create inventory. It then sells that inventory, which creates what we call accounts receivable. It's basically an IOU from a customer. Then, when the customer pays up, that IOU turns back into cash. And hopefully, the company has more cash than when it started. The whole cycle begins again. This is the very heartbeat of a company's performance. But for this story to be truly accurate, accountants follow one absolutely crucial rule. It's called accrual accounting. And all it means is that you record income when you've earned it, and you record expenses when they happen. It doesn't matter when the cash actually moves. This gives a much more honest picture of performance because it perfectly matches the costs with the revenues they helped create. Here's a perfect example of that in action. Let's say a company made a bunch of sales, and now it owes its salespeople $6,000 in commissions for making that happen. Now, even if it only paid out $5,000 in cash by the end of the year, the income statement has to show the entire $6,000 expense for that year. Why? Because that's what it cost to generate that year's revenue. And that unpaid $1,000, it doesn't just vanish. It shows up on the next balance sheet as a liability, a promise to pay later. Okay, so we've got our snapshot, the balance sheet, and we've got our story, the income statement. Now for the magic trick, seeing how they perfectly connect to give us that full, complete picture of a business's health. So check this out. We start the year with our first snapshot, the balance sheet, on January 1st. Then, for the whole year, the income statement tells the story of what happened and calculates the final profit.
Now, who does that profit belong to? The owners, so it flows directly into the owner's equity section of the balance sheet, which creates a brand new, updated snapshot for December 31st.
And that right there is the key. That's the whole secret. The profit, the result of the year's story, is the bridge that connects last year's snapshot to this year's snapshot. The two documents are totally interlocked, telling one continuous financial story.
So, why did we just go through all that? What's the point? Well, it's because once you understand this connection, you have a powerful new lens to see any business through.
With just these two documents, you can start to read a business. You can see how it's funded. Is it drowning in debt or built on solid ground? You can see if it has enough cash on hand to pay its bills next month. You can track if its performance is getting better or worse over time. You can actually start to get a real feel for what a business is truly worth.
And you know, the real beauty of all this is that the language of accounting is universal. The same exact principles we just talked about, they apply to everything from your local coffee shop all the way up to a giant global tech company.
You see, the numbers don't lie. They tell a story of struggle, of smart strategies, and sometimes of incredible success. Now that you know the language, the only question left is what stories are you going to find?